When the market moves up a lot like it has recently, when the market moves down a lot, that's volatility, and that can be very scary if you're operating a short-term strategy, because those moves tend to happen very quickly. That's why we take a step back. We take more of a long-term approach. We get asked a lot, how should we look at our risk tolerance? What kind of questions do I ask myself to know how much risk that I should take on? With a long-term strategy, you hear a lot of times about the averages in the market, that over the long term, the S&P 500 for the last, 50 years has averaged between 10 and 12%, depending on, which time period you're looking at. So you kind of get in your mind, okay, 10 to 12%, that sounds really good to me. With even if inflation's running at 3% or so, I'm beating inflation, which, growth is the antidote to inflation. But what do I have to tolerate on a short-term basis in order to get those long-term goals? And that's a very important question that you should consider before you ever invest your first dollar. Risk tolerance should be viewed differently if you're in the accumulation phase of your investor life cycle, which is the point at which you're working, you're earning income, you're having extra money to invest, versus when you get into the distribution phase of your investor life cycle. That's when you reach the point where you feel like you've accumulated enough money where you can cease the activities of employment, drop your regular paycheck, and start to use the investments that you've accumulated to fund the rest of your life. During accumulation, it's my opinion that most people, as long as they can emotionally handle it, should be able to take more risk. The more risk that you take, the faster. Risk and return are very positively correlated, which means that the more risk you take, the more return you should make. Once you get into the distribution phase, where you're starting to live off of the income sources that you have earned and accumulated up to that point, and using your savings and your investments to supplement that, you need to be much more focused on having less volatility in your portfolio, which also means that you have to settle on less return. That 10 to 12% is not a realistic expectation for someone in the distribution phase of their investor life cycle if you're following our strategy, because we believe there's much more value in protecting against downside volatility once you get there. What you have to really consider is, what is it going to take in the short term to make me abandon my long-term strategy? Because folks, we live in a short-term world. With the information that's readily available, you can go out on the internet and you can make the case for just about anything you want to make these days, and you can even get AI to help you do it. But because we live in a short-term world and we see the markets are up, the markets are down, you have all this information that's happening. What does that mean from a long-term perspective? Well, let's take a look at kind of 3 different risk tolerance levels. If you think, well, if my portfolio, if the value of my account goes down 5% or more, and that would cause me to get out, your volatility range is, the most volatility I can really handle is between a drop of 5% and a gain, and I'm happy with a gain of 10. I'm really happy with a gain of 10%. So if your range of volatility is that narrow, on the long term, you probably should expect a return of somewhere in the 3 to 4% range. In the kind of the middle ground, if you say, well, I can handle more than a 5% drop in values in my portfolio before I consider totally abandoning my strategy, and I can handle maybe a negative 10, and I'd be really happy with a positive 15, I think you should set your long-term expectations for an average of around 6 to 7%. On the flip side, if you're going for that 10 to 12% average return, then you should be prepared in the short term for volatility extending almost 50% to the downside, with an upside potential for 64% in a positive year. So you have to be able to stomach a whole lot of volatility if you want a whole lot of return.